Welcome to This Explainer. We're jumping straight in today because we're unpacking a massive, gathering storm in the financial sector that honestly almost everyone is missing. When we talk about asset tokenization, the conversation usually revolves around treasury bills or real estate. But a far more volatile front line is opened up. We're talking about the tokenization of traditional bank deposits. And as you'll see, this threatens the very foundation of how credit is actually created.
Okay, let's dive into this. $700 billion. That isn't just some abstract, eye-catching statistic. That is the actual amount of U.S. commercial bank lending capacity that is currently at risk of being completely wiped out. We're talking about hundreds of billions that would normally fund local small businesses and housing just evaporating. To really grasp how a seemingly simple tech upgrade could cause such a massive credit contraction, we have to look closely at the mechanics.
Section 1. The tokenization fault line, the systemic liquidity drain.
So, the Federal Reserve Bank of Dallas recently sounded a very urgent alarm about third-party fintechs, specifically fintechs that are wrapping traditional deposits into 24/7 digital tokens. Think about the journey of a single dollar. Under the traditional finance route, your deposit goes straight into a bank vault, and it becomes the stable, sticky foundation for a local 30-year mortgage. But what happens if you take the fintech route? A third party promises you instant tokenized settlement. To back up their shiny new token, they park your cash in narrow reserve accounts. To the issuing bank, that totally reliable consumer deposit is literally just mutated into flight-prone hot money.
And when you completely remove friction from the system, deposit stickiness drops to zero. We are fundamentally shifting from a world where money moves in slow, predictable banking days to a new reality where programmable money moves in absolute milliseconds. Users can shift funds across decentralized protocols with just a swipe, and when money can vanish based on a single algorithmic trigger, banks lose the dependable foundation they absolutely need to function.
Section 2. Anatomy of bank fragility, the engine room of economic growth.
Let's look under the hood. Banks create economic growth through what's called maturity transformation. Basically, they borrow our short-term liquid deposits to fund long-term productive assets like mortgages and business loans. But doing that creates a multi-trillion-dollar vulnerability. If you look at the entire U.S. banking system, there is roughly $7 trillion in total long-term interest rate exposure. Out of that $7 trillion, a staggering $5.8 trillion is entirely funded by deposits. Banks are basically gambling on the assumption that those deposits won't just suddenly disappear on them.
And this brilliantly illustrates the sheer scale of the problem. A massive 80% of all long-term asset funding relies strictly on these deposits that are now at risk of walking out the door. If fintech tokenization turns those sticky deposits into frictionless, hypersensitive cash equivalents, the math completely breaks down. Banks simply cannot hold fixed-rate, long-term assets without taking on what could be fatal liquidity risk.
What's really fascinating here is how regulation actually acts as an accelerant. Enter the liquidity coverage ratio, often called the LCR penalty. Current rules force banks to treat these new wrapped fintech deposits as highly volatile wholesale funding. Because of that, banks must hold virtually 100% of that value in high-quality liquid assets, like cash or short-term treasuries, just in case that hot money flees. So if 1 million people tokenize their cash, the bank can't lend it out into the community. They literally have to lock it up in a vault. That single regulatory reality effectively sterilizes $700 billion of credit capacity from the broader economy.
Section 3. The silent digital run and vulnerabilities in the shadow. We've seen what happens when the money stays but gets neutralized. But what happens when the money actually runs?
Well, think about historical bank runs, like in the 1930s or even 2008. The panic was highly physical. It took time for real humans to line up around a city block or wait for clearing windows to open. The danger was measured in days. But in the fully tokenized world of 2026 and beyond, withdrawals are measured in milliseconds. If an on-chain protocol suddenly offers even a fraction of a % higher yield, smart contract liquidation bots go right to work. These algorithms, they don't sleep. They will ditch deposits at 3 o'clock in the morning on a Sunday without a single second of human hesitation. That strips banks of any buffer time to survive a liquidity crunch.
And this dynamic sets up a deeply dangerous asymmetry. The fintech layer gets to capture all the glory. They get the customer loyalty, the interchange fees, the programmability premiums. Meanwhile, the underlying traditional bank gets shoved into the basement as a low-margin utility provider. They are left holding the bag on all the balance sheet risk, the FDIC insurance costs, and the massive capital charges. Long-term, it's just a completely unsustainable model for the future of credit.
Which brings us to Section 4, Native Tokenized Deposits, the TradFi counteroffensive.
So how did traditional financial institutions actually survive this? Well, first off, we have to acknowledge that outright prohibition simply fails. Policymakers might instinctively want to ban third-party deposit wrappers, but regulatory walls absolutely do not stop technological demand. Corporate treasurers demand 24/7 programmable cash. And if domestic banks are banned from providing it, capital is just going to behave like water. It will flow to wherever there's programmable efficiency, inevitably leaking right into offshore, unregulated shadow banking channels.
So the crucial point is this. The actual solution is something called BITD, or Bank-Issued Tokenized Deposits. Unlike a third-party synthetic token, a BITD is a direct claim on a regulated bank that exists natively on a distributed ledger. Because the deposit actually stays on the bank's balance sheet, it preserves its low run-risk status. It retains that vital FDIC protection, and most importantly, it maintains the bank's ability to actually fund long-term loans. This is exactly how traditional finance can offer full on-chain programmability without cannibalizing its own core engine. Finally, Section 5, the Modern Banking Playbook, Strategic Imperatives for Survival.
If banking leaders want to plug this $5.8 trillion drain, there is a definitive 3-step blueprint. Step 1, stress test your deposit base against rapid tokenization outflows today, before those automated bots do it for you. Step 2, build shared, interoperable ledger rails. The future of this space is about consortia, not isolated, walled-off gardens. And Step 3, partner aggressively with regulators to ensure legal clarity, making absolutely sure that native tokenized deposits receive identical regulatory treatment to traditional ones. The message here is clear. Modernize your liabilities right now, or surrender them to third parties forever.
As we wrap up this explainer, I want to leave you with one final provocative question to chew on. Who will control the rails of deposit liquidity? Look, tokenization is absolutely inevitable. But whether it strengthens our economic productivity or triggers a devastating $700 billion credit squeeze depends entirely on who builds the infrastructure. The technology itself isn't the enemy of traditional finance. Passivity is. Thanks so much for joining me to unpack this massive shift. Keep questioning, keep learning, and we'll see you next time.